Welcome. Welcome, everyone. It's Angelo Robles. Pretty rare for me to do back to back evenings here in the summer, but it's exciting to be with all of you. There's a lot on my mind. And when I saw the sale by Jennie Buss of the Los Angeles, started to put some math together. And it started to get me thinking about families. A couple of them I reached out to today, and a little bit back to my roots, really as a hardcore investor, effectively, first and foremost. So I haven't done much in the last 2 months, a little bit of a teaser on investing. It's been mainly AI, global issues, effectively geopolitics, macroeconomics, which, of course, to me, all of that does come into investing. And I have some special guests upcoming over the next couple of days to week that will, again, the word I use, take us a little bit back to our roots as being hardcore investing family offices. So, what I would like to do is for my members, I'm going to let some of them in here. And why don't we begin? I'm going to call this investing and family offices, the strategy behind the stories. And we'll start actually with that story, the debate that I kind of led with. So I'd like to begin with the headline that for many of you, sports fans or not, is making the news. Jennie Buss has sold the Los Angeles Lakers for $10 billion. Now, let's put that in context. So the Buss family purchased the Lakers back in 1979 for about 67 million. So they've had an extraordinary return and an iconic story truly of the Buss family, a real estate family at heart, and generational wealth creation. But there is a part, as much as I love my sports, that I think many of you miss because it's not quite as sexy as the story of investing in a sports team. That same 67 million, if invested passively in the S&P 500, would be worth roughly the same as that $10 billion. Oh, and by the way, liquid, not tied up, not a single entertainment industry or company, the fortunes of the NBA, etc. Now, if it had tracked the NASDAQ 100, now we're going to be fair about this in a second, but if it had done that, it would be worth 27.5 billion, 2.7 times X more than the Lakers sale. But we do have to be fair. The NASDAQ 100 was informally created until 1985, and you really couldn't easily, at least through an ETF or mutual fund, directly invest in it probably until the triple Q, as I remember, in 1999. Now, yes, we also have to admit, besides potentially cash flow, tax advantages, the Lakers delivered massive, and I do mean massive, non-financial status returns. So again, admit it, there are tax benefits, legacy value, and intangibles. But I think many of you are caught a little off guard by my comments, especially with, again, the tech-centric and heavy on more future-forward companies like the NASDAQ, just crushing one of the most iconic brands in sports in terms of what a return could have been. But still, I think the lesson is, again, the liquid, diversified, technology-driven public markets have quietly or not so quietly been compounding wealth really at extraordinary levels. Is that going to continue? It's unknown. Did we have an incredible run broadly over much of the last 40 years? But there's been gravely challenging periods as well. You could argue that. So maybe what I'm broadly saying, and in talking to some families today, while investors are chasing the hip and cool private deals, sports teams, often which you have no control over, even at blocks of 100 million. You don't even have a seat at the table. Real estate and prestige assets, the market did what it always does when left alone, and I know that's hard to do. It rewarded patience. So I'm going to kind of call this part, I think, public markets reconsidered. Family offices too often dismiss as it's just a part of the portfolio. The public markets they consider as crowded and fully valued. But let me ask you, does liquidity matter? What is more liquid than like the triple Q? What gives you access to the world's leading companies? I know it's not super exciting. You want the sports team, the sexy deal. And we're going to get to some of that shortly. But what gives you access to the world's leading companies with currently a huge AI tailwind, no bureaucracy, and fees near zero? Now, I have a lot to say about that, what I consider some principal and agent issues and problems in the family office and some wrong mindsets, but we'll save that for a debate and another day. Now, sure, volatility absolutely exists, but your family offices are ultra high net worth investors, assuming you don't need that money now, next year, the year after, then it's that shouldn't matter. Look at the math, look at the history, look at blocks of over 10 years. The stock market just crushes. Now, are moats eroding? Is AI changing everything? Sure. So if you're allocating capital for decades, volatility per se is not risk. Losing purchasing power is, and missing out on asymmetrical upside is. Now, why even consider picking singular stocks? Well, there's actually several reasons, but the core aspect of what I mean to say is unless you believe a stock will consistently outperform a benchmark, why take that idiocentric risk? But if you do believe it will outperform, then for part of your portfolio, absolutely. So, what should family offices look for instead? Well, if they're looking at public companies and potentially individual stocks, I think it's pretty straightforward. This was talked about in the book 100 Baggers, and you hear Druckenmiller and others talk about this as well. Cash flow machines, businesses that can reinvest or return capital with consistency, long runways, although traditional moats, we could argue, are crumbling. Tailwinds, think demographics, energy, and for sure AI. Oh, definitely supply and demand, as my friend investor James Sowers says, supply and demand within a given market infrastructure. Now, that could apply to both the product or the service or technically to the stock itself, but that's another deeper discussion for a different time. Very important, capital allocation discipline. How are the CEOs, the management of these companies allocating their capital? I would definitely also look at quarter over quarter growth. It certainly is one of the core things that I look at, the heartbeat effectively of momentum investing, but really more than that. And of course, management matters. The quality of the management team, the CEO, is the founder CEO, assuming they're good and have a lot of skin in the game. Think of Zuck, think of Jensen. Those are the examples that absolutely that could matter. Now, always remember, back when I was doing more investment-centric programs, even earlier in the first quarter, like you don't have 50 best ideas. You maybe have 3 to 7. Now, we're going to get to allocation percentages and where that could come into play shortly. But I'm going to go back to what I did say in certain videos over the last couple of days. And I'm not the only one, Jordy Fisher and others who I respect. All roads, all indicators, all roads lead through AI and to a little bit of lesser degree, Bitcoin, crypto, stable coins, and the future rails of the financial system. As I've said before, and I'll say it again, all roads are leading through AI. That doesn't mean that I put all my eggs in that basket. I get it. But this is not just type, it's direction. And I feel a lot of investors and family offices are missing this. I mean, I'm going to get off topic for a second and really be future forward. And my members get this, and I'll talk a little bit about this in my masterclass coming up next week. AI is rewriting the rules kind of a company formation. Soon, the best returns won't even come from investing in traditional startups. They'll come from investing in solo entrepreneurs with resources to build billion-dollar companies, micro teams, probably more realistic, and a utilization of autonomous AI agent networks that operate 24/7. The definition of companies is effectively changing, and you got to get with the times. You have to be abreast of this. But I admit I do digress. So I'm going to talk about, there's no one perfect model. For me, the 70-20-10 in terms of percentages that add up to 100%. So to me, it's been a structure that works. Family offices won't need to swing for the fences every time, and I don't think they should. So perhaps 70% of the portfolio is anchored. And I know it's volatile. I said it earlier, but look, the past is no assurance of the future. I would look at the triple Q as being a strong anchor. I personally may want to own directly 30 of the top stocks that I choose from that, but let's be a little broader. The triple Q. How about Schwab's US dividend ETF, the SCHD? I think that's very interesting. Yeah, of course, you're going to want to have some money in short-term T-bills. For me, definitely Bitcoin. And that probably is somewhere from 7 to 12. For some, like Jordy, who I mentioned earlier, and others, that may be well above 15-20%. I don't quite have the guts for that. I used to a couple of years ago. And I do love me gold and silver. I could argue direct physical ownership, more so for geopolitical single country sovereign risk. But again, a different subject for a different time. Well, that certainly gives you liquidity, exposure to exponential tech, sovereignty money, as I call it, in real assets. And if an incredible opportunity comes along where you needed liquidity, well, it is there. I'd probably have 20% in something for me that would be more what I would loosely call controlled privates, probably owning and probably controlling. I know that's more work, boring businesses that are often somewhat recession resistant to counterbalance my AI centric portfolio, cash flow positive, niche, somewhat defensible. Again, ideally, you would actually control them. I know that's more work. Now, real estate, very fascinating, and some tax advantages. If you have an edge in a given geographic area and you're politically connected, if that matters, and you really know the market, whatever, Austin, Phoenix, San Francisco, maybe real estate, even it could be a great anchor core of your 70% for you. But for most people, no. Now, yes, sports teams, if you got a billion or billions to burn in today's days, the challenge is you throw 50, 100 million on the table. You do not have a seat at the table. You have no control. And remember my Jennie Buss story, who did have control. So, and I would put 10% hyper aggressive, high conviction frontier. For me, a little bit of Ethereum and Solana. I mean, I kind of do like Altria, but maybe that's me being a little boring for a second. I love Texas Pacific land. That is one I really like. I do believe in some diversity of currency, but again, I'm getting a little off track to purely the investing perspective, the Swiss franc, the Norwegian krona, maybe the Singapore dollar. I love Palantir. So I'm only going to invest if I feel it's going to be, say, the triple Q. And I definitely believe Palantir over a block of 2 to 3, 3 to 5 years will absolutely do that and probably become a Fortune 10 company. I kind of lightened up a little bit on ASML, Taiwan Semiconductor. I like some of the space tech plays, Rocket Lab, AST, Space Mobile, Redwire. In private markets, I think Ripple could be interesting as XRP in the future rails. Oh, not a private market anymore is Circle. Love Circle and stable coins. That is I think that's kind of a home run. For a private company, but good luck, company like Anduril and that entrepreneur, again, the second time around too, he's amazing. Now, you may not like what they do. It may not fit into your perspective of impact investing, and I don't know, a lot of these SPVs, I have ideas about that, but we'll save that for a different time as well. I'm interested in the retail front that's integrating AI and ThreadUp. I think a good old boring company like Coca-Cola could still be good here and there. IES Holdings, which does the kind of the infrastructure components, that's the better word, of data centers. Tesla, but I'm getting exposure there through Triple Q. I could argue the same with NVIDIA. And a little bit of a shocker, take a look at what IBM's been up to. Very intriguing, possibly intriguing on quantum, but overall, it's been pretty good. Now, I do have some very small positions in a variety of quantum plays. I spoke more about this in January in Miami at one of my events, and they're modest. But yeah, I'm looking for massive returns on those, and those are very, very volatile. We're going to save a whole program on that for a different day. I mean, basically, the point is you allocate the 10% towards edge and exposure, not for comfort. If you have a weak stomach, it's probably not for you. Briefly, I would note a couple of tools, and this goes back to tech and AI. If you're running a family office or even investing institutionally, something like one of my members, his first name is Dan, told me about Mosaic ML, kind of for financial modeling. Ooh, I love it. It's really good. And what I like even better for some of my private company investments, a pitch book is good, but it's very pricey. I'll look at Inven.ai, INVEN.ai, for investment research across effectively private companies. I still love Bloomberg for public companies. The Bloomberg AI feature, their chat, their GPT, it's good. It's really good. I know you're not going to like the price. I hear you. So, I mean, everything is changing. LLMs, AI agent orchestration tools to simulate due diligence, model risk, and find second order, if that's the word I'm looking for, insights. And these are things why you got to get more fluid, not just investing in AI, but what it could do for your family office, your investing. It could be a game changer. So back a little bit to, well, final thought, but back where I kind of begun. The Buss family sold the Lakers again for $10 billion. And it was a spectacular outcome, and it gave them lots of fun and accolades that perhaps money can't buy. I do understand. But again, I go back to, assuming it was available, they had simply brought and held the NASDAQ 100 over the same time, they'd have what, 2.75x more. So the lesson isn't don't invest in sports teams. It might be that's the right thing to do. But the lesson is don't confuse visibility with return. Don't confuse prestige. And I know that may matter with performance. And don't ignore what compounds quietly while the world, of course, always, and it seems like only, chases headlines. The world of investing is built, or I guess rebuilt is the word, in real time, and family offices that embrace liquidity in today's markets, that gives them optionality to maybe buy things at a significant discount. I'm not as experienced in real estate and many sectors in private companies, but if you really have a skill set and connectivity for that, for more than just 5, 10, 15, or 20%, that might be the way to go. I'm not looking to talk you out of it. The future belongs to those that could filter through the noise, see clearly, and most importantly, act clearly. Like, I don't know what's going on with a lot of the CIOs, these investment committees, bureaucrats, too many of them. More coming up on that this summer as well. And yes, AI and AI agents, unless you're telling me that Stan Druckenmiller and some other incredible investors are part of your investment committee, you'll be shocked what AI right now could do. So I talk about let's build a future together intelligently. So this now takes me a little bit back, and thank you all for joining us. It seems like no matter what I do among what the core 10 subjects, geopolitics, macroeconomics, definitely AI, again AI, more AI on infrastructure, on architecture, the family office, on family office structuring, on philanthropy, on holding companies, nothing beats getting an audience engaged like talking about investing. And I think, unlike effectively everyone else, as more the thought leader and community people in the family office community, I'm okay with naming names. Now, my members get everything, including those quantum plays and other things I'm doing, how I'm accessing certain private deals, or I feel more comfortable than through certain SPVs and other things that I do, because I am an active allocator. And sometimes not really a good one, as I put more money passively. And I admit the last 2 years have been great. It's actually been way better for me. And I didn't really sell Bitcoin in 2022. And again, some of the best investments that I made, I'm not going to say set it and forget it, but a little bit. I didn't look at it every second and look to get in and out of it. Now, maybe with that 10% of my portfolio that keeps me alive, I think I got to track my metrics with my AI on that a little better. But I'm glad I was able to throw out some names at you. Again, everyone has different risk tolerances, time horizons, cash flow needs. You may hear this now, and a month later, it could be a completely different perspective, definitely months or a year later. Who knows? At the end of the day, do your own diligence, make your own decisions, because when you invest, you can absolutely lose money. You might even lose all your money. Now, could that happen also with 30-year treasuries? Who's to say? So I think we overcomplicate this. Now, one question I think that someone did state is it different for a gigantic, a decabillion to really more multi-decabillion family office? Yes, it's harder and harder for them to move the needle. And that is an example where ownership and control of sports teams, select private companies, global diversification. I know it's hard for me to say this, but at that level, and sometimes for smaller as well, being an LP in certain very, very high quality funds can be a logical decision. And even for smaller families, I just look at the math. I look at what I get, and no liquidity. Effectively, there's secondaries and things like that. We could get a little cute about it. No control. I kind of like control, except for some of the private companies, of course, I'm investing in. And effectively, manipulation of benchmarks and other metrics that I don't like. And I'm sorry. Oh, the hedge. I'm effectively based in Greenwich. I've been hearing about the hedge fund industry turning around for years. Most of them are asset gatherers, but there are some in venture capital, private equity, real estate, and others, especially for very, very large families, that can make more sense than maybe some of the more sub-billion-dollar family offices that I'm talking about here. But the principles of what I'm talking about are absolutely still applicable. So happy to answer any questions, but it is a little late at night. The Indiana Pacers and Oklahoma City Thunder are on Game 6. I am a big sports guy, mad at Indiana for knocking out my Knicks, my New York Knicks, about a week and a half ago. So, and I'm an Oklahoma Sooners fan in college football. So I guess I'm indirectly, although without a lot of passion, but going for the Oklahoma City Thunder. And again, maybe a dream of mine, if I was worth a lot more money than I am now, even though it sounds like I just talked myself out of it during my conversation today, is owning a sports team. I know Gary Vee talks about that. I'll even take a minority interest where I have zero say, zero control, and I'm probably not really going to do that good comparative to if I put that money in the triple Q in certain AI companies and Bitcoin, and I'd be liquid. I'd probably crush what I'm doing. But the prestige, the opportunity, the private box, the meeting the majority owners, the wearing that on your sleeve and taking people there, I suppose that does matter. So again, no rest for the weary. I'm extremely busy this summer. And again, the world is in utter chaos. I've actually looked at less geopolitical and macro indicators than I did a year or two ago. I know I like to talk about those subjects a lot with incredible people and thought leaders, but it was Adam Robinson who told me you're probably overdoing it on the metrics and things you're looking at. Really simplify that. Again, I'm okay with volatility. I'm a long-term investor. And I think the premise that I laid out today, even for significant billion or more than $1 billion families, I admit at the top 100 family offices, it does get more complicated and there is a different perspective. that I would take to a degree, Again, I think the family office industry complicates things. I do think there are principal agent issues. And that gets to the complexity inside the family office and compensation. And it's a whole other issue that, again, I'm not afraid to tackle those subjects, but you all seem to get mad at me when I do. So again, incredibly active summer. I think you all already know now about Monday and Tuesday, June 23rd and 24th, my AI Family Office Masterclass. And again, these tools, some of them are traditionally fintech, but more modern fintech, and some of them AI-centric, they are incredible. And if you were a part of the masterclass, you would learn about that. And you would build more of your own sovereign systems and do more, sometimes more, not only better and quicker, but more with less better and quicker. Depends what you're looking to do. And I try to do the right thing in terms of what I hold true in a holdco in a family office and somewhat some part-time and staffing that I have as well. But on that front, again, I want to start to watch some NBA. Going to have a late night dinner. I've already had a cigar, so we're done with that. Maybe one a day now is really all that I'm down to. I hope you enjoyed this more investing-centric discussion. Really only other than that one question, no other questions came in. I'm happy to talk about it. My members, you'll be getting more specific content. I got 2 incredible guests coming on the next 30 days where we're going to name 30 incredible stocks and opportunities, at least from our perspective as allocators and investors. And again, in the world of AI, robotics, drones, and quantum, and I am all in. So it'll be fun. An incredibly active summer. Go to angelorobles.com, join, become a member, learn also about my AI Family Office Masterclass, and stay tuned. Even more publicly, I'll be doing a notch more investing over the summer, actually for my members. And I don't really list it on the website. We'll be doing a series of soirees, 2 or 3 breakfasts, 1 or 2 lunches over the next 2.5 months in New York City. And effectively, they're going to be 90% really investing centric. Some incredible guests that some of you have heard, like Ram Alawalia on my program before, James Sowers and others will be joining us. We're going to get really deep, a little bit of arguing and yelling, but trust me, we'll also do family office structuring. I got a really interesting program coming in on hyper advanced tax strategies. I think I'm going to do something on sports teams because I'm really into that now. And of course, I'm going to do more on AI and AI family offices. It's an exciting time. Jump in, everyone. Go to angelorobles.com. Everyone, thank you so much. Have a good evening. And NBA fans, enjoy. Thank you.